The year 2026 so far has been a year of change. Changes in the capital markets, changes in technology, changes in the outlook for interest rates, and changes in geopolitics. Where are we headed from here? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update. Date today is June 23rd, 2026, and today we'll be discussing what we believe to be the main factors driving stock and bond markets today and going forward. My name is Paul Latta. I'll be doing most of the speaking today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin our presentation today with the discussion about recent market action, stocks, bonds, and other assets. Then we'll look at the macroeconomy to add some support behind the market discussion. Then we move to a microeconomic view and look at key industry-specific drivers. And then we'll conclude with some longer-term observations about the investment landscape. The S&P 500 is up 26.7% in the trailing 12 months year-to-date through June 22nd, as shown on the left. A very good performance for a one-year period, though we had a noteworthy pullback of nearly 10% in March with the onset of the war in Iran. The chart on the right shows the S&P 500 is up 89.2% over the last 5 years, and that there have been a couple of pullbacks along the way, including the Iran war pullback this year, as well as the Liberation Day tariff pullback in April of last year. The bond market is up 4.5% in the trailing 12 months. Much of that gain was from last summer and reflected the tailwind of rate cuts from the Federal Reserve back then. The bond market has been in more of a trading range in 2026 as the Iran war appears to be putting more rate cuts on the back burner. Over the last 5 years, bonds are up 0.2% as shown on the right. It's good to see that long-term returns finally get above zero and begin to put that bond bear market of 2022 in the rearview mirror. Oil prices have been dominating discussions in the capital markets given the sizable move since the Iran war began on February 28th. As you can see here, crude oil popped to over $100 a barrel in short order as Persian Gulf nations were not able to safely ship any oil through that bottleneck at the Strait of Hormuz. But oil prices have since dropped about 3/4 of the way back to the normal pre-war prices amid a combination of inventory drawdowns, presidential jawboning, widening crack spreads, demand destruction, and more. We'll talk more about these factors later in the presentation. The Fed has been in a neutral stance in recent months, a stance that remains unchanged despite the changing of the guard with Kevin Warsh replacing Jay Powell as the new Fed governor in recent weeks. Rate cuts last year were limited amid the fog induced by tariff policies last year, but now with volatile oil prices, rate hikes are increasingly probable. The consensus for future Fed rate moves has flipped from dovish to hawkish due to the oil price spike related to the Iran war. Prior to the war, implied probability was suggesting 2 rate cuts over the remainder of 2026. Today we have the opposite. As you can see in the path of the blue boxes here, the implied probabilities are now suggesting 2 rate hikes before year end. Quite a change. The U.S. Federal Reserve is not the only global central bank likely to raise rates in 2026. Indeed, in recent weeks, we have already seen rate hikes from the European Central Bank, the Bank of Japan, and the Royal Bank of Australia. Higher oil prices related to the Iran war are creating an inflationary impulse all over the world, not just the U.S. The U.S. Federal Reserve is actually lagging 3 of its 5 largest global peers. The 2 charts here show the path of future rates for the big 6 central banks, with the chart on the left being the relative move and the chart on the right being the absolute move. Both charts show essentially the same thing. Global central banks have a hawkish bias to raise interest rates due to the potential inflation threats related to war in the Middle East. Here we have the S&P 500 charted over the last 10 years in blue, and the valuation of the S&P 500 using the price-to-earnings ratio in purple. As you can see, the S&P 500 has done well over the last decade, lifting just over 323%. Some of that is due to increasing valuation as shown in purple, but most is just improved earnings over the years. The present price-to-earnings ratio, or PE ratio, is 20.9, which is just over the middle of the 10-year range of 14 to 24. The stock market is not overvalued here. Investment returns by sector are showing little in the way of surprises. The tech sector is still getting that enormous tailwind from AI, and tech stocks had led the market year to date. But tech did not lead the market in the first quarter. Energy stocks actually were ahead of tech stocks in the first quarter at the start of the Iran war. However, energy stocks did not hold on to those gains and lost most of those gains in the second quarter. At a broad level, when looking at performance by style factor, what worked in the first quarter, income and value, generally backfired in the second quarter. And vice versa, styles that underperformed in the first quarter, like momentum, well, they roared ahead in the second quarter. Much of that rotation in style factors was simply related to energy spiking in the first quarter but then faltering in the second quarter. And of course, this was happening amid the background of AI growth and adoption. The US S&P 500 flipped from underperforming global peers in the first quarter to being one of the best markets in the world in the second quarter. A big part of the sharp lift in the U.S. stock market relative to other bourses is the fact that the U.S. has a lot of publicly traded chip stocks at nearly 20% of the S&P 500. In other words, the U.S. outperformance was brought to you by an AI-driven chip rally. But the U.S. does not have the biggest exposure to chips. Indeed, that would be South Korea, where Samsung and Hynix account for nearly half of the Korean Kospi stock index. And the Korean Kospi stock index has rallied over 120% year to date. Energy exposure was again a factor in relative outperformance in the second quarter, but to a lesser extent. In the first quarter, recall bourses of energy exporting countries generally outperformed, but in the second quarter, those bourses did not decline, but were actually fairly flat for the quarter. Bourses in energy importing countries were weak in the first quarter, but aside from a modest bounce in the India bourse, most were still weak in the second quarter. Volatility of the S&P index lifted strongly at the outset of the Iran war, and by May the so-called VIX index had dropped to a fairly low 15 to 16. We're presently at about 17, suggesting all is calm. Or is it? While the index volatility is indeed low, the volatility of individual stocks is now at an all-time record high. We've touched on this gaping juxtaposition in prior slideshows. Why are individual stocks seeing such massive volatility, yet the overall index is seeing volatility near yearly lows? Here we list 6 common explanations for the massive volatility in individual stocks, a list that's in order of magnitude of impact. At the top of the list, we have heavy buying of short-dated options. We'll talk a little bit more about this on the next slide, but right behind that, we have algorithmic herding. That's a phenomenon we discussed in detail on our prior slideshow, and mainly reflects the fact that with the proliferation of AI tools, algorithmic trading has spread to the retail masses, but they're all using the same tools, creating a herding phenomenon. Also on the list is the proliferation of levered single stock ETFs and the clustering of investment narratives, of course, driven by AI. Quite a bit of discussion about Mag 7 concentration, creating liquidity imbalances since it's easy to sell a $3 trillion mega cap, but a lot harder to swap that into a $50 billion non-Mag 7 stock. And of course, there is also merit to the idea that today's macro regime has more uncertainty. But again, this list is in order of impact, so we'll have an extra slide to look at on the impact of short-dated options here. This chart shows the impressive rise of short-dated single stock options. The volume of single stock options has risen fourfold over the past 10 years. Over half of today's volume, 55%, is from short-dated options, up from a tiny 9% in 2020. And that is led by 0 days to expiration, 0 DTE options, and driven mostly 60% by retail investors, not institutional investors. Bear in mind that when short-dated options expire, there's forced short-term buying and selling, which increases single stock volatility. The activity is especially concentrated around earnings releases for single stocks. This chart is only one of 6 reasons behind the record-breaking level of single stock volatility, a record that is frequently overlooked amid the calm, placid lack of volatility of the overall S&P 500 stock market index. With the stock market back to record highs, the market for initial public offerings and secondary public offerings has heated up. But the deal pipeline is unlike any we've ever seen before, given the size of the massive unicorn IPOs and the massive hyperscaler secondaries. If the calendar of equity issuance holds up, the amount of equity issuance in 2026 is so large that it may in fact dwarf the buybacks from the rest of the S&P 500. As you can see in the bottom panel of this chart, share buybacks have been running about $300 billion per year, yet there is over $300 billion of equity issuance on the deal calendar for this year. So net equity issuance may go positive in 2026, creating the risk that there will be more share supply than share demand. Let's look at that stock offering calendar in more detail. The calendar here shows over $323 billion in share issuance in 2026. That's about 10 times the size of a normal year of equity issuance. A couple of these deals have already moved forward. SpaceX completed its IPO just last week, and Google completed the non-shelf portion of its secondary offering. Oracle has also partially completed its shelf. But we still have Anthropic and OpenAI, both sizable IPOs, and there's a host of other smaller deals waiting in the wings like Cerebras, Discord, and Databricks. Bulls would point out here that investors have a lot of dry powder here with a record $8 trillion parked in money markets. And with SpaceX and Google mostly behind us, we're already about a third of the way done with the issuance. Bears would counter that the equity funding of hyperscalers and LLMs will not be isolated to 2026. CapEx will persist for years, and that will mandate more capital. Perhaps not forever, but likely beyond 2027 and 2028. One implication here is that the ever-present mantra that share buybacks are the only thing holding up the stock market, well, that may disappear as a mantra, either because the mantra was wrong and the stock market holds up despite the new positive issuance, or because the mantra was right and the stock market comes under pressure from more share supply than share demand. We'd now like to move on to part 2 of our slideshow, the economy. We'll begin by looking at GDP growth in the developed world. GDP growth was positive in most regions of the world in the prior quarter, a handful of exceptions, of course. Some deceleration is shown here in Europe, Mexico, France, and Sweden, but all 4 of those regions had anomalous factors that do not really suggest weakness will persist, and most of those anomalies were related to reversing reactions to last year's tariffs. Some of the troubled areas from the prior quarter saw rebounds. Norway saw a lift in its petroleum and transportation sectors. South Korea was strong on, well, no surprise, but the booming semiconductor market, as well as fading fears about the elimination of fiscal stimulus. The jobs market remains healthy as shown here. The last monthly employment report showed a solid 172,000 increase in non-farm payrolls, a third month in a row of strong payrolls increases. Unemployment remains steady at a fairly low level of 4.3%. These 2 charts make an interesting compare and contrast. Consumer confidence on the left has softened a bit, but still remains about 3/4 of the way from trough to peak. Consumer sentiment on the right shows a complete collapse, and it's at an all-time low. How is it possible that consumer confidence is above average and consumer sentiment is at an all-time low? Well, as you can see at the bottom below each chart, consumer confidence does not measure the same thing as consumer sentiment. Consumer confidence measures current business conditions and the labor market, and hence is really a measure of job security. But consumer sentiment, well, that measures personal finances and long-run expectations, especially inflation, and hence that's more a measure of financial security. And that is where consumers are today, very secure about their jobs, but deeply worried about their financial situation. Inflation is on the uptick worldwide since troughing in 2023 to 2025. The initial uptick was related to ripple effects related to America's new tariff policy last year. And while tariff policy is mostly reversed in the last few months, we're getting a secondary inflation impulse from the tensions in the Middle East and the blocking of the Strait of Hormuz. Most countries have seen inflation lift just under 2 percentage points higher than where it was in the trough. Let's move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. Our 5 microeconomic topics today include: where is oil headed, or whither oil? Revolution medicine wows the oncologists. Will the SpaceX unicorn thrive as a public company? Reconciling a volatile market with a bad market, and the AI narrative versus everything else. Let's start by revisiting the oil markets with whither oil? The Iran war has created a bigger problem than oil prices might suggest. As you can see here, the Iran war has created the biggest oil supply disruption in history. Indeed, the blockage of the Strait of Hormuz has disrupted 20% of global oil supply. By comparison, the Arab oil embargo of 1973 was 1/3 that size, disrupting a smaller 7% of global oil supply. And the 2022 Russian invasion of Ukraine, well, that was about 1/5 the size of the Hormuz disruption. In these prior disruptions, oil prices spiked anywhere from 100% to 300%. Huge moves. How does that Hormuz price spike compare? Despite the record level supply disruption, oil prices lifted less than they did during the Russian invasion of Ukraine, and nowhere near the spike we saw in the 1973 oil embargo. Further, the 2026 price spike has already reverted most of the way back to where prices were prior to the disruption. If this is the biggest supply disruption ever, shouldn't the price spike be the biggest ever? If so, oil should have blown through $200 and maybe even $300. What's causing the massive attenuation of oil prices? For those watching markets day to day, top of the list of explanation is the so-called presidential jawboning of the oil markets. In the first 100 days of the Iran war, President Trump announced the end of the war a total of 38 times. And with each announcement, oil traders sold long positions for fear of not knowing what the president may know. In addition, the U.S. and other countries drew down emergency inventory held in strategic petroleum reserves. Economists would also suggest that the price spike, while less than one might expect given the magnitude of the disruption, well, that may have resulted in some demand destruction, an effect that seemed most prevalent in China in particular. Lastly, oil analysts have noted that refinery capacity dropped with damaged refineries, especially in the Persian Gulf and select other regions of the world, maybe Russia. Less refinery capacity means less consumers of crude oil and less elevated prices of crude oil. With oil having retraced most of the spike, does that mean oil has returned to some level of normalcy? Well, not entirely. Progress has been made, but geopolitical challenges remain. Three in particular we show here. Iran governance is in disarray and troops may simply ignore the diplomats in any ceasefire agreements. Secondly, the conflict between Israel and Hezbollah may well continue, reflecting the disconnect between Israeli interests and U.S. interests. Lastly, the present agreement does not really address nuclear issues but pushes that resolution out 60 days. That window may be too narrow to reach any conclusions. Street consensus on year-end oil price targets are split into two camps. Optimists are suggesting successful diplomacy will see Hormuz reopen and oil prices drop to maybe $65 a barrel. But the other camp is less optimistic on the present ceasefire and diplomatic efforts, and they see oil rising back to $95. Our own read here is that the present price of $73 is fairly close to where we are headed in the back half of the year, but the route will not be a straight, flat road. There will be more than a few bumps and spikes along the way. Notably, oil futures are suggesting $67 by the end of 2027, a figure which seems fairly reasonable in our view. Let's move on to our second industry topic. Revolution wows the oncologists. An exciting time in the world of oncology research with a long overdue breakthrough in the treatment of pancreatic cancer with a drug from a company called Revolution Medicines. The stock has quadrupled in the last year on successful clinical results from their drug, daraxonrasib. Revolution put out solid phase 1 data in September of last year and immediately pushed the drug into phase 3. And in April of this year, Revolution published unprecedented phase 3 results in pancreatic cancer. Pancreatic cancer is actually one of the most lethal forms of cancer with a 5-year survival rate of less than 3%. Extensive research over decades has yielded virtually nothing until this year. Daraxonrasib nearly doubled survival rate over standard chemotherapy, an unprecedented result. Revolution presented the full results at a study in June at the American Society of Clinical Oncologists in Chicago. This picture seems to capture what this really means, a room full of thousands of oncologists giving a standing ovation for a full 60 seconds. This is one of the toughest audiences on earth. On the right, you can see daraxonrasib is blocking a mutated protein that fuels growth in over 90% of pancreatic cancers, a target that has eluded treatment for decades. While oncology research advanced another step forward, daraxonrasib is not an immediate panacea. There are side effects, as you can see on the left. Most of the side effects are lower order, grade 1 or grade 2. This is a kinder and gentler, certainly than chemotherapy, but rash is very common, occurring in 87% of patients, and there are gastrointestinal side effects. Also, daraxonrasib just completed phase 3 testing and has yet to go through the FDA approval process. That means the drug is still 1 to 2 years away from mass market approval. As shown on the right, there is the NDA filing, the FDA filing decision, and the FDA review. There may also be a panel review. In the meantime, there will be an expanded access program for compassionate use. The earth-shaking results on daraxonrasib raise the question about what else might be in the Revolution Medicine research pipeline. As shown here, there are other possible uses for daraxonrasib in lung cancer and colorectal cancer, and there's other drugs in the same class of RAS inhibitors, mainly zoldonrasib and elironrasib. Notably, we do not expect another phase 3 readout for the balance of the year in 2026, though the lung cancer study of daraxonrasib ought to read out in late 2027. Revolution is not the only biopharma company studying the RAS inhibitors. Should we be stepping up to buy into other names that might have similar results, perhaps in other cancers? While there is likely to be another breakthrough or two in the next several years, that it's a tad difficult to depend solely on the RAS inhibitor thesis. Most of the RAS studies are buried in big pharma like Lilly and Bristol, or tied into opaque Chinese trials like Hengrui and Genfleet, or not reporting data for 3+ years. Is Revolution fairly valued? We tend to simplify valuations of early stage biotech using a price to sales multiple on anticipated peak sales. The analysts are presently split on projections of peak sales, with some saying a blockbuster at $4 to $7 billion in peak sales, but the others saying not enough. This is a mega blockbuster at $10 to $12 billion in peak sales. If we use a weighted average of $9 billion in peak sales, the present market value of $34 billion puts price to sales valuation multiple at 3.8 times. That's within the normal range of about 1.5 to 5 times peak sales. Naturally, there's a wide range of uncertainty, and peak sales projections are for the 2032 timeframe, quite some time in the future. Our take is that the valuation here is fair to full. Our take here on Revolution Medicine stock is that it's likely to take a bit of a breather in here, but it will still hold on to most of those sizable gains. Daraxonrasib appears to be a huge breakthrough, and there will be no competition for several years. There will likely be label expansion to other cancers, and there are other RAS inhibitors in the pipeline. That said, we fear that enthusiasm may have peaked with that ASCO standing ovation. Indeed, in prior breakthroughs like Biogen in Alzheimer's or Gilead in hepatitis C, the stocks seemed to peak with the data release, not on FDA approval or on the sales ramp. Also, the FDA approval process has not yet started, and there always seems to be some data nitpicking that raises concerns. Revolution is not overvalued in here, but it's not really cheap either. So we remain on the sidelines here for now, but may revisit on any sort of pullback. Let's move on to our next topic. Will the SpaceX unicorn thrive as a public company? This past week, SpaceX completed the biggest IPO in history, raising $85.7 billion and bringing the market value to over $2 trillion. On the left is the front cover of the offering prospectus. Another sign of the size of the deal is the 22 investment banks listed on the front cover of the offering prospectus here, including the 5 on the top as the joint book runners. Since the IPO, the stock has done a so-called pop and drop, with the stock popping from its $135 IPO price to $225 within 3 days, but then dropping all the way back to $147 by day 6. This price-seeking behavior is relatively normal for any IPO and seems likely to continue. The IPO market is well known for inefficient market behavior. Sometimes that works for you and sometimes it doesn't. Here we can see the median one-year performance for IPOs going back over the last 15 years. Median one-year performance overall is actually not that great at -2%, but some IPO years are better than others. The median IPO gained 25.5% in 2013, but the median IPO lost 61.1% in 2023. The transition from private markets to public markets can be challenging. Public investors are clearly more attuned to profits and less attuned to the narrative compared to the, say, private markets and venture capital markets in particular. This means that public unicorns, well, they're just a little bit less special in the public market than they are in the private market. SpaceX growth projections are big. Consensus is calling for a 6-fold increase in revenue by the year 2030. The biggest contributors to that growth are expected mainly from the AI segment, the data centers. In addition, consensus is showing fairly sizable growth from the connectivity segment, a segment that includes the core Starlink satellite constellation. Starlink growth is expected to benefit from increased penetration of other niches, including mobility markets, government and defense markets, and direct-to-cell markets. Street consensus is still evolving with the newness of the IPO, but at present revenue is expected to be $210 billion by the year 2030. On today's valuation, that puts the valuation at 10 times 2030 sales. On the one hand, that is well above the S&P 500 multiple of 2.6, but the story stocks, they tend to trade with multiples at around this level. Indeed, Musk's other venture, Tesla, back in 2010, traded as high as 24 times 2012 revenue. SpaceX is not out of line with pure story stock valuations, though that range is quite wide and not very helpful in attempting to pin down a specific number. With SpaceX falling into that story stock category, it helps to think through what parts of the story are compelling and believable and what parts of the story are more of a long shot. Here we list the 6 components of the SpaceX story ranked by our own interpretation of believability. At the top of the list is the terrestrial data centers, a very compelling story since demand is clearly enormous and SpaceX has the cash flow from Starlink that might fund that growth. Starlink itself has a fairly compelling story, though growth from here is a little bit more incremental compared to the past. Grok may be a smaller business, but it too can be funded from Starlink cash flow. Beyond these 3 key stories, the other aspects of the SpaceX story have a little bit more difficult to swallow. The X or former Twitter business is likely to see very little growth in our opinion. Orbital data centers, well, they offer a very compelling story, bypassing many of the terrestrial constraints, but we're skeptical of the technical challenges, especially related to heat dissipation and carbon footprint concerns. Lastly, that man on the Mars story, well, that they may well use SpaceX rockets, but seems unlikely within most investment horizons. IPO stocks can jump around a lot amid uneven share allocations and repositioning, but our read is the stock will remain above its $135 IPO price with a significant near-term fluctuations. SpaceX has the dominant position in space and connectivity and a very clear tailwind in terrestrial data centers. Cash balance post-IPO is a sizable $100 billion, and the stock is likely to get added to the S&P index over the next year or so. At the same time, SpaceX is faced with enormous capital spending that may well exceed Starlink cash flows. Orbital data centers get a lot of publicity but face technical challenges that are not really resolved. SpaceX also has encroaching competition from the likes of Amazon's Blue Origin and Leo, as well as Anthropic and OpenAI. SpaceX will be seeing IPO lockup expirations beginning as soon as next quarter, and Elon Musk may be a visionary, but may also be distracted running too many companies. Again, we believe the stock will remain above its $135 IPO price, but there will be significant fluctuations between the $135 and $225 that we saw just earlier last week as the stock works through its post-IPO price-seeking period. We're going to move on to our 4th topic, reconciling a so-called volatile market with what people are reluctant to refer to as a bad market. We have to ask the question, is the phrase volatile market just a euphemism for bad market? The word volatile is really defined as sharp fluctuations in price, both up and down. But in markets that are steady down, without much fluctuation, just steady down, they are still persistently described as volatile. Why is this? The root of the confusion about the word volatility really lies in the options market. Options prices are derived from what is known as the 5 Greeks. 4 of the Greeks are based on simple data inputs of stock price, time to expiration, and interest rates. But the 5th Greek, the vega, is the measure of how that option price changes with volatility. The street convention here is this, that if the option price is not explainable with the 4 easy Greeks, that implies that the move was due to expected volatility, also known as the implied volatility. Alas, though, there are other factors besides expected volatility that can move option prices. Most notable would be a so-called bad market. This chart here shows the S&P 500 in yellow plotted against the CBOE Market Volatility Index in blue. Note here that every market dip over the last 10 years was accompanied by a lift in that implied volatility index, or the VIX index. This chart again shows the S&P 500, this time plotted in red, and we're plotting it against the CBOE put-call ratio in blue. Notice how the put-call ratio spikes whenever the S&P 500 dips. This basically means that everyone starts buying puts as the market dips. Why is that? Well, it's because put options go up in value quickly when the market goes down. Indeed, put options are a well-known form of portfolio tail risk management, or tail risk insurance. If the put prices rise because everybody's buying puts in a market dip, even in an orderly, non-volatile market decline, the put price will be attributed to what else? Implied volatility. Oops. Why is the price tag on tail risk insurance being labeled as implied volatility, even in a non-volatile market decline? Why is the implied volatility misnomer still with us? Well, euphemisms actually have a place in the world of human beings. It can certainly soften a jarring reality, like a bear market. It also helps investors save face. It can improve perceived politeness, and it can reframe a discussion of market action. It can also, unfortunately, mask true intentions. Is there a better term? Well, CNBC and Bloomberg TV frequently refer to the VIX index as the so-called fear gauge. Well, that certainly seems more accurate. Others simply refer to the price of tail risk insurance or the cost of hedging, also more accurate. If the VIX is a better measure of fear than volatility, well, what is the better measure of volatility? Well, the easiest way to look at actual volatility is to know that 92% of the daily returns on the S&P 500 are within plus 1% and minus 1%. So if the daily moves go outside plus or minus 1%, the stock market is volatile. A string of these wide moves would be even more meaningful. For those who want a simple metric like the VIX, but one that tracks actual volatility instead of the price of tail risk insurance, the chart below is a slightly fancier approach. The Bollinger Bandwidth widens or increases when the variance of returns increase. Bollinger Bands are just the standard deviation around a 20-day moving average, so a high Bollinger Bandwidth would be an actual volatile market, regardless of the price of tail risk insurance as measured by the VIX. Let's move on to our fifth and final industry topic, the AI narrative versus everything else. As present-day investment narratives go, artificial intelligence is still the dominant narrative, as shown here pictorially. Indeed, a quick check on FactSet shows that artificial intelligence, or AI, was mentioned on 68% of the company earnings calls in the past quarter. That is well above competing narratives like Middle East tensions and inflation at 47% and 44% respectively. GLP-1s or weight loss drugs, a big narrative 2 years ago, has dropped to a mere 7%. Large investment narratives are composed of constellations of sub-narratives. Within the four main AI sub-narratives, the AI infrastructure sub-narrative on the left is presently the most dominant, and the AI infrastructure narrative can be broken further into four sub-sub-narratives as shown on the bottom. The compute and memory narrative can be further broken down into GPUs, TPUs, high bandwidth memory, and other chips. The narrative constellation is not static, but it grows, evolves, and it branches. One recent evolution of the AI narrative has been the bifurcation of the AI technology plays into so-called check receivers and check writers. Check writers are largely the hyperscalers, and the stocks have been under pressure recently with enormous capital spending burdens, slower monetization of AI, and margin pressure. In contrast, the check receivers are mostly the semiconductor or chip companies that are seeing explosive revenue and cash flow growth, multi-year visibility, and expanding margins. In a world where the AI narrative is so dominant and at a seemingly unprecedented level, it's notable that the AI narrative is pushed through to earnings estimates in a manner that is also unprecedented. Earnings estimates are notorious for softening over the course of the year. Over the past 25 years, the S&P 500 earnings estimates have dropped 1.5% over the course of a typical year on average. Estimate increases almost never happen. But in 2026, the S&P 500 earnings estimates have actually lifted 6.3% in just the first 5 months of the year. And most of that positive surprise was from AI infrastructure, especially the chip companies like Micron and SanDisk. Now, admittedly, there was also a bump from oil earnings, but oil is fairly small. It's only 3.5% of the S&P, not a big weighting compared to technology. So the market may be elevated on enthusiasm for the AI narrative, but the AI narrative is also dropping money to the bottom line. Before we conclude today, we have one more slide looking at stock market cycles over the long term. We've been in a bull market for a total of 44 months now. Should we be worried about an imminent bear market? Well, bull markets seem to last a little longer than many expect. Of course, we've had shorter bull markets. Of course, the post-COVID bull market lasted a total of only 21 months. But the bull market that began in 1987, in contrast, well, that lasted a lengthy 148 months. Of course, bull markets do not turn into bear markets due to a simple calendar or date of expiration. Rather, bear markets are precipitated by events, perhaps the COVID pandemic, a subprime crisis, Gulf Wars 1 and 2. Such events can dramatically alter the landscape. So investors will need to really pay attention to the ever-changing market narrative. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.